Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Intel.
If you find our talks useful, please consider subscribe, like, and comment underneath because imagine you're looking at a balance sheet, right? And you see a net loss of $3.7 billion over just 3 months.
Yeah, most investors would run for the hills.
Exactly. They panic. But what if I told you that the smartest institutional money on Wall Street, the absolute titans of the tech sector, are actively cheering on that loss? They are actually pouring billions of their own cash into the company just to keep that spending going.
It's quite the paradox we are unpacking today.
It really is.
And, to set the stage for why this specific analysis matters so much right now, you really have to understand the massive narrative shift happening in the broader market.
Right.
Intel is no longer just, that legacy PC vendor making the chips for your old desktop computer.
So like the stickers we used to have on our laptops.
Exactly, the little blue stickers. They are right in the middle of this explosive parabolic shift. They're transforming into a highly volatile AI growth momentum powerhouse. And just to put some real numbers to that, the stock has surged 466% over the past year.
Wow. 466.
Yeah. It is, frankly, the defining market story right now, going from a slow value turnaround play right into a high-stakes momentum engine.
And, since we are tracking such a high-stakes, incredibly volatile asset today, this is actually a really good time to mention a useful chart tool for investors and traders who are watching this play out.
Oh, yeah, definitely.
If you want some help reading trading charts more clearly and just cutting through all that market noise, you can check out VIP Algos through the link below in the description. Basically, VIP Algos is this TradingView indicator suite, and it's designed to give you a much cleaner visual workflow.
Which you definitely need with momentum like this.
Yeah. Exactly. It shows visual buy and sell chart alerts, trend direction tools, support and resistance zones, and even take profit and stop loss planning areas. But just remember, VIP Algos is strictly an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it absolutely does not guarantee profits. Trading always involves risk, so manage your risk carefully and do your own research. And this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Awesome. So now looking at this massive shift from legacy hardware to a major momentum powerhouse, we really have to reevaluate how this fits into an actual investment strategy for you.
All right, let's move into the wealth building context.
So when we look at this from the perspective of a long-term investor, this stock fits very squarely into a growth and turnaround portfolio profile. The structural tailwinds of AI are really the wind in the sails here. We aren't just looking at a company trying to sell a few more laptops or, upgrade some corporate servers. We're looking at a fundamental re-architecting of how data centers physically operate. And the company is aggressively positioning itself right at the base of that new structure.
Wait, hold on. A 466% surge over 12 months? That screams speculative hype to me. Are we sure we aren't just, buying a finished skyscraper at peak prices right before the market corrects?
See, that is the core tension right there. But you aren't buying a finished skyscraper. You have to look at this more like investing in a massive multi-year infrastructure project.
Oh, okay, how so?
You're buying into a blueprint. You're buying the pouring of the concrete, the laying of the rebar, and that physical blueprint is going to take years to fully materialize.
I get it. Which means this isn't a quick flip. Holding a stock that's undergoing this kind of heavy physical and operational reconstruction, it requires a massive amount of patience.
A ton of patience.
And a very high tolerance for execution risk, because you are essentially financing the construction phase, knowing full well that the ribbon-cutting ceremony is it's years away.
Exactly. And to truly understand the sheer scale of that construction phase, we really have to trace exactly where the capital is flowing today.
All right, since we need to follow the money to see if this construction project is viable, now let's look at the fundamentals.
Yes, the numbers coming in right now are really a study in contrasts. So in the first quarter of 2026, revenue hit $13.6 billion.
Which is huge.
Yeah, it was actually a 9% beat versus expectations. But the really critical metric is where that money is coming from. The data center and AI segment, which is often called DCAI, that jumped 22% year over year.
Wow.
Yeah, the AI-driven businesses now make up a full 60% of their total revenue.
Okay, so those top-line revenue numbers sound great. But, we have to address the elephant in the room regarding the profit and loss reality. The bottom line is carrying a massive headwind. Overall, in that same exact first quarter, there was a net loss of roughly $3.7 billion.
Right.
Losing that much capital in just 90 days is staggering. I mean, where is the bleed coming from?
Well, you have to split the business in half to see the mechanics of that loss. That data center and AI segment we just talked about, it actually generated $1.5 billion in operating profit.
Oh, okay, so that part is working.
Very well. The core franchise is incredibly profitable and it's growing. The bleeding is coming entirely from the foundry segment, the actual manufacturing side. That posted an operating loss of $2.4 billion.
Okay, let's break down why a foundry loses $2.4 billion in a single quarter. Because it's not like they're just misplacing funds.
Right, it's not going missing.
This is the sheer capital intensity of semiconductor manufacturing. Building out a new fabrication plant specifically for their new 18A process, it requires ordering massive, extreme ultraviolet lithography machines. And those cost hundreds of millions of dollars each.
It's mind-blowing.
You are basically funding years of atomic-scale research and development before a single chip even rolls off the line.
Which brings us to the balance sheet and their competitive moat. Because if you are burning billions building these next-generation factories, you need an incredibly deep war chest.
Yep.
And they have one. There is currently $17 billion in cash on the balance sheet. But the source of that cash is the real story here.
This is the fascinating part.
They recently secured a $5 billion equity injection directly from NVIDIA.
Unbelievable.
Add to that $2 billion from SoftBank and a $5.7 billion disbursement from the CHIPS Act. They're building a moat to become what is known as the CPU as orchestration layer for AI.
To go back to our infrastructure analogy from earlier, their financial state is a lot like a household undergoing a massively expensive, multi-billion-dollar basement renovation.
I love this analogy.
Right. That renovation represents the negative free cash flow of building out the 18A manufacturing process. If you just look at the monthly household budget, it looks terrible. The cash is just flying out the door.
Flying out.
But it's being entirely funded by the wealthiest neighbors on the block, like NVIDIA and SoftBank, because those neighbors know they are going to need to rent out that renovated basement to build their own products later.
That is the exact mechanism at play. The neighbors are paying for the renovation because the global supply chain desperately needs the space.
That brings us to the catalyst timeline.
The most immediate thing to watch is the upcoming Q2 2026 earnings. The focus there isn't just on the raw revenue numbers, it's on pricing power. There's a potential 10 to 15% average selling price increase on the table for server CPUs.
That's a big jump.
Huge. Because there are such heavy hardware supply constraints right now across the entire industry, they actually have the leverage to raise prices. And that would flow directly into boosting those profit margins.
Right.
But, the much bigger structural catalyst, the real macro shift, is something called agentic AI.
Wait, let's unpack that.
Yeah.
Because AI is a buzzword that gets thrown around constantly. What makes agentic AI structurally different from the AI we've seen over the last few years? And why does it change the hardware equation?
Good question. So traditional AI, like early large language models, it functions on a linear single-pipe data stream. You give it a prompt, it processes it, and it spits out an answer.
Right, like a chatbot.
Exactly. And GPUs are incredibly good at that raw brute force calculation.
Yeah.
But agentic AI is fundamentally different. It operates more like a decentralized grid network.
Okay.
You give the system a broad goal, and it autonomously spins up dozens of sub-agents. It breaks the goal down into parallel tasks. It might send one agent to scrape the web, another to write code, and another to analyze a database, and it does all of this simultaneously.
Ah, I see. And that changes the hardware ratio because GPUs are designed for heavy lifting, right? Not complex traffic routing. For a long time, the ratio in data centers was moving toward 1 CPU for every 8 GPUs.
Right, it's very lopsided.
But agentic AI pushes that ratio back toward parity. You need significantly more CPUs to act as the traffic cops, basically managing the complex logic and orchestration of all those parallel tasks across the network.
Precisely. And to build the chips capable of acting as those advanced traffic cops, well, you need the factories running smoothly. So the other major catalyst is manufacturing milestones. The yields on their new 18A manufacturing process have reportedly improved to over 60%.
Let's clarify why that 60% number is so vital for you listening. When a factory produces a silicon wafer, it contains hundreds of chips, but not all of them work.
Right, there are always defects.
The yield is the percentage of functional chips that actually pass quality control. Getting over a 60% yield is the critical tipping point, where the unit economics finally make sense for mass commercial production. Anything below that, and the cost per functional chip is simply too high to be profitable.
And what makes that 60% milestone a major catalyst is that it reportedly outperforms competitors.
Yeah.
For instance, Samsung's competing SF2 process is allegedly struggling to hit those commercial yield thresholds. That gives an opening to capture massive market share.
I hear all of this, and, the technological shift makes total sense. But we have to ask the hard pricing question.
Always.
Is that 10 to 15% price hike and all this agentic AI potential, is it already priced into a stock that has run up 466%? Listeners really need to beware of fake timing confidence here. We know these structural shifts are happening, but predicting exactly which quarter that translates to a massive bottom line beat, that is incredibly difficult.
It is. And because the fundamental timing is so difficult to pinpoint, we really have to look at how the market is actively positioning itself around these unknowns.
Now let's pivot to the chart.
Looking at the price structure, the stock closed recently at $114.68, which puts it up 177.6% year-to-date alone.
Just massive.
Yeah. What we are seeing right now on the daily time frame is a classic momentum breakout consolidation. It's forming a flag pattern with a strong base of support establishing in the low 110s.
And the momentum and flow of that trading is highly volatile. It is incredibly news-driven right now. Just recently, we saw it stage a 3% recovery right off a 5-session losing streak.
Right, that bounce was telling.
When you see a sudden bounce like that at a key technical level, it usually indicates strong institutional dip buying. The big algorithmic players and institutions are stepping in to defend the price when it dips to those specific support zones.
But remember, charts only show probabilities based on historical human behavior. They never show guarantees. A flag pattern doesn't guarantee an explosive breakout to the upside. It just shows us where the battle lines are currently drawn between buyers and sellers.
And because this stock is so incredibly volatile, just swinging wildly on every piece of macro news or yield rumor, it highlights exactly why having a clean visual workflow is so important.
Right.
You need to be able to identify those support zones in the low 110s without getting completely overwhelmed by all the intraday noise. That goes right back to why tools like VIP Algos can be really helpful for charting those specific planning areas.
Which naturally leads us to question what is driving those institutional buyers to defend those levels in the first place.
So what does market sentiment look like?
The mood among analysts and institutions is what I would call constructively bullish on the underlying AI thesis, but very cautious on the valuation multiples. Wall Street is actively raising price targets just to catch up with the sheer momentum. Wells Fargo raised their target to 110. Mizuho pushed theirs all the way to 128.
But analyst upgrades are often a dime a dozen, right? They tend to lag the actual price action. The real sentiment shift comes from where the smart money is actually deploying hard capital.
Yes, and that is exactly why NVIDIA's direct $5 billion equity investment is the ultimate institutional stamp of approval. That single move shifted the entire market narrative literally overnight.
It's massive.
It wasn't just a speculative hedge fund buying shares. It was the undisputed king of the AI hardware sector looking at the 18A manufacturing blueprint and saying, we need this foundry to succeed, and we are putting billions onto their balance sheet to make sure they do.
Right. And alongside the hardened facts like that cash injection, there are also some massive speculative rumors driving sentiment right now. There is currently an unconfirmed whisper in the market of a preliminary deal with Apple.
Oh yeah, the Apple rumor.
Yeah, to produce low-end M-series processors on that new 18A manufacturing process. If that happens, it would be a colossal win for the foundry business, proving they can attract the most demanding clients in the world.
But we really have to separate fact from whisper here. Even if a preliminary handshake with Apple happened today, the engineering and testing cycle means we are years away from that showing up as actual revenue on an income statement.
Years.
It is crucial to separate the hardened facts, like the $17 billion currently sitting on the balance sheet, from speculative market narratives that just drive short-term trading frenzies.
And speaking of separating fact from frenzy, we need to address the darker side of this valuation.
Now let's talk about the risks.
Yeah, the extreme valuation here requires a very healthy dose of skepticism. The enterprise value has shot up to $568 billion. Let's just put the valuation metrics into context. It is currently trading at 42 times EBITDA, For comparison, TSMC, which is currently the dominant proven foundry in the world with fully operational factories, they trade at only 24 times EBITDA. So we are paying nearly double the multiple for a company that is still building its blueprint.
It gets even steeper when you look at the price-to-earnings ratio. It has a forward PE of 143. You are paying $143 today for every $1 of expected future earnings over the next year.
That's incredibly rich.
Furthermore, you are taking on this position when the broader macro market as a whole is sitting at its priciest valuation in 155 years.
Those valuation metrics are stretched thin, there is just no denying that. And it ties directly into the execution risk. We mentioned the foundry is losing $2.4 billion a quarter right now. The 18A process is a massive margin drag. If those complex manufacturing yields stumble and fall below that critical 60% threshold, or if these hyperscaler deals with companies like Google and theoretically Apple fall through, the entire bullish narrative collapses. The current valuation assumes they execute the most difficult manufacturing turnaround in history perfectly.
That is the exact definition of being priced for perfection. At 143 times forward earnings, the market isn't giving them any room for error.
None.
Even a slight stumble in execution, like a delayed factory opening, a minor yield issue, a design flaw that could trigger a severe pullback because the premium built into the stock price is just so overwhelmingly high.
So with everything on the table, what's the final verdict?
Based on all the research and really balancing the massive structural tailwinds against the extreme valuation, we are giving this a bullish score of 7 out of 10.
Okay, a 7 out of 10.
The stance here is a multi-year hold. The transition to true volume production for their new manufacturing processes requires a 2 to 3 year horizon. It is going to take at least that long for the actual income statement and cash flows to catch up to the premium valuation the market is pricing in today.
So you really have to wait it out.
Yeah. To summarize, the main upside driver is the company becoming the foundational orchestration layer for agentic AI, backed by serious hyperscaler partnerships and massive cash injections. The main downside is that extreme valuation paired with monumental foundry execution risk. If they don't build the 18A process perfectly, that multiple evaporates. And as a clear reminder, this analysis is strictly for informational purposes and is not financial advice.
But here's a final thought to mull over as you watch this play out. If they successfully execute this turnaround and firmly establish the CPU as the necessary orchestration layer for agentic AI, resetting that data center hardware ratio back toward parity, does that make them a bigger long-term threat to traditional CPU rivals like AMD, or even to the GPU dominance of NVIDIA itself? Keep a very close eye on how those data center hardware ratios evolve over the next few quarters.
That's a great point.
And, if you want a cleaner visual workflow to read these incredibly volatile trading charts, check out VIP Algos through the link below in the description. VIP Algos is a TradingView indicator suite featuring visual buy and sell alerts, trend direction tools, support and resistance zones, and TPSL planning areas. It can help make complex charts easier to scan, but remember, it is still only an educational chart analysis tool. It is not financial advice, it does not place trades for you, and it does not guarantee results. Trading involves risk, so always do your own research and manage your risk. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if this analysis helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Deep Dive.